Welcome to Retirement Rescue Radio, a show specifically designed to help retirees and pre-retirees maximize their financial efficiency so you can live the retirement lifestyle you've always imagined. Your host is Nate Miller, investment advisor representative and author of the CPR Retirement Rescue Roadmap. Nate discusses thoughts and ideas from some of today's most knowledgeable professionals in the field of finance. He offers strategies along the way to help you make better financial decisions so you can maximize your retirement. This is Retirement Rescue Radio.
All right, Retirement Rescue Radio listeners, I'm your host, Nate Miller. We've got another episode here, and we're going to call this episode The War on Retirement Plans. And we've got Josh Miller here. We're going to kind of go over this and going to give you our thoughts of it. Josh, how you doing?
I'm doing all right, and I'll try to keep my thoughts mainly filtered.
We'll try to keep them as filtered as we can, I guess. The great thing about this is we can always edit out something that doesn't fit, right? But first off, so we're probably going to go on a little bit of a rant here today, because the topic we're going to be going over, it ticks both of us off a little bit. And so it's some of the new stuff that has worked its way into Biden's tax proposal. And by now, you guys have probably listened to, I don't know how many episodes that we've done on Biden's proposed tax changes. And so it's almost like we're just beating the same drum or kicking a dead horse or something. Or it's beating a dead horse, isn't it?
Yeah, I think so.
And so more and more just keeps coming out, and there's more developments. And we want to talk about the implications that could happen if even a portion of some of these ends up going into law. And so what's crazy, if you read some of the, what do they call them? The summaries, Josh, they don't have if you don't want to read through the whole entire bill, it kind of gives you the highlights, right? Cliff notes, whatever. And one of them said that the purpose of this legislation is to avoid subsidizing retirement savings once account balances have gotten too large.
What?
So I don't understand that. So, I thought the point of saving money for retirement was to get that large account balance. So what constitutes too large, in quotes, and who gets to define what too large means? So it's like, Congress is saying, I'm sorry, middle America, you did what you were supposed to do. You did a good job of saving, but now your accounts are too large. So we're going to have to take more of it in taxes now. That's kind of what they're saying now. That's personal opinion. So it might be me that needs to get filtered in this one. And just to clarify, this is not a Republican or Democrat post or podcast episode here today, because there was some stuff that happened under the Republican legislation under Trump that I didn't agree with and still happened. For example, when he enacted the Secure Act, and part of that was he was pushing the required minimum distributions back to age 72. I'm like, all right, that's good. But then they did away with the stretch IRA. So now you have to have, when you pass away, all of your IRA money has to be taken out of that account by your heirs within 10 years. And that was estimated to cause billions of extra tax money. And that was enacted under a Republican. And so here's more tax increases that are enacted under a Democrat. So this is not Republican or Democrat that we're talking about here. This is just taxes and government in general. And in my opinion, government is just overreaching no matter who's in office right now.
Yeah, the Democrats and the Republicans, they just say we're going to tax different places. Like they both, start raising taxes. It's just what's their mantra? Who are they saying they're going to tax?
Yeah, it's almost like they talk out of different sides of the mouth when they're running, but then when they get in office, they just lead from the same place.
Yeah.
Let's just increase spending. Let's do nothing about decreasing our debt or decreasing our spending. Let's just increase what we bring in, increase taxes. That seems to be it. So here's what, Congress has described this tax proposal as a way to more equitably distribute taxes. And a lot of it is focused on, quote, the rich, right? And however, I feel like a lot of my clients are going to be finding out that Congress thinks you're rich. So, because at this point, Congress gets to define who's rich, right? And that's the problem.
Change the definitions all the time.
Yep. If they control the definition of who fits what narrative, then it's just a matter of changing another law to make someone else fit into that narrative. So my feelings are, this whole big tax the rich movement that seems to be gaining a lot of steam, or corporations are bad and wealth is bad. Well, guess what? Pretty soon they're going to define you as being wealthy, and now you're bad. That's what's being set up here. That's the precedent that's being set. And so this, I guess, coming together of all of the different things that they're wanting to enact right here, I feel is the biggest assault on retirement savers that I've seen in my lifetime. That's my opinion. Biggest assault that I've seen. Because we're wanting to fundamentally, they see all this money now that's just sitting there in all those retirement plans. And they're also seeing their deficit and the huge national debt and unfunded liabilities. And they're seeing that big chunk of money sitting there going, I think I'd like to get my hands on that.
Yeah, there was a number, I can't remember, maybe you do, Nate, that there was 20-some trillion dollars in American retirement savings. And lo and behold, we have 20-some trillion dollars in national debt. So they're like, hey, we need to get a hold more of this money. So not everything, but they're doing what they can to really get at all that money. And it's really wreaking havoc.
Exactly. And so we listen to we've got resources and friends that actually used to be on Capitol Hill. It's like they spent time in Washington. That's what they did for their job. And
they were not politicians, though.
Yeah, they weren't politicians. They were basically working for politicians, and now they don't. Why? Yeah, you can figure that out. So anyway, well, and what they're saying is scary about these proposals. And I agree. As I was looking at these, I'm just like, this is horrible, because it's the precedent that's being set. Because once something is put in place and defines the limits on how much can be put in or how much can be taxed, or the possible converting of tax deferred to tax free or whatever, those limits, once those limits are in place, and now it's easy to change them. Very easy to change. And the hardest part is passing that framework that puts the limits in the place to begin with. But once they're in there, they can easily be moved. And so some of the changes that they're wanting to make, this first one, I think I mentioned this in a past podcast episode, but we're going to be going into some ones that I have not touched on yet in any episodes. But the first one is they want to raise the top capital gains rate to 25%. We've talked about that one. It's a heck of a lot better than raising it to, the ordinary income tax rate of 39.6 plus your extra 3.8% Medicare surtax plus state tax and all that. So it's better than paying more than 40%. Definitely better. Still, it's an increase, but it's definitely better. What stinks, though, is there's a couple things here. They're wanting to tax capital gains annually for, quote, they say billionaires, right? This was put in by Senator Ron Wyden. He's the ranking Democrat on the Senate Finance Committee. And he said it was a promise that he made to release a proposal that could fundamentally transform how the U.S. taxes capital gains for the wealthy. And the reason that they're wanting to do this is because, once again, they're using the terms rich and wealthy. But guess what? A lot of my clients, y'all that listen to this is the way that your money works too. It's like, just maybe it might have a few less zeros, but this is how your money works. If it's outside of an IRA or outside of a Roth IRA, every year you might have a gain in your account, but you don't have to pay any tax on that unless you actually sell it. That's what capital gains or after-tax accounts, that's the result. That's the tax implication of those accounts. You don't pay tax on what goes in, you only pay tax on the gain, but if and only if you sell it. So you could literally just let it grow, never pull anything out, and now you've got all this unrealized capital gains. Unrealized means you haven't sold it, realized means you have sold it and now owe tax on it. And so you've got all of this unrealized capital gains. And what they're saying is the, quote, wealthy receive the vast majority of their income from that type of income, capital gains income, rather than, job income or business income. And so by taxing it every single year, so if you have a $10 million, actually the way it's set out here, if you have, his paper suggests that a taxpayer must have income exceeding $1 million or net worth exceeding $10 million with at least one of those two tests triggered each year for 3 consecutive years. before that taxation happens. So not billionaires, not billionaires, millionaires, 10 million. And that's not that high of a limit. And so here's what
far cry from a billionaire.
Yeah, exactly. Yeah, far cry from a billionaire. And so they want to tax those gains. So now let's say they've got $10 million and it's excess. Sorry, it's anything above the excess of that 10 million. So now if they have $10 million and all of a sudden it goes to 11 million, well, now they have to pay tax on that $1 million. So they're probably going to now have to sell some stuff in order to pay for that. And so they want to do that each and every year that someone falls under those categories. You're going to have to pay tax on all of that gain. And if you remember a lot of my podcast episodes in the past, if you sell something, if you have a few things that maybe that happened in 1 year and 2 year, well, apparently in this case, if it happens 3 years in a row, now you are considered wealthy or rich, and you're going to owe those extra taxes. So here's the problem with this, though. Josh, what's going to happen in the years where the people that actually qualify for that, what's going to happen if they have losses?
Oh, they get a big refund, right?
That's right. Are these rich people getting checks cut by Congress back to them for the losses?
Yeah.
Yeah. And whatever percentage, whether that's 25% or whatever the percent that they're charged, if they have losses, is Congress cutting a 25% check on the amount of loss? If we're going to get taxed on our gains, what happens when we have our losses? Are we going to get, because right now, if we have losses in those types of an account, right, it's not a big deal until we actually sell it. They're unrealized capital losses. So there's not really a tax benefit yet at this point, unless it's sold. So if it's sold at a loss, well, then normally we get a write-off on our taxes by doing that. But in this case, if they're assessed every single year and we're not able to carry those gains over, so that part really hasn't been ironed out very well at this point. So there's a lot of issues that are with that one. But once again, it identifies and defines a specific category of people, and then they could probably just adjust those. It's 10 million now, maybe it's 5 million later. Maybe it becomes 1 million of net worth before you have to start paying that. So that's the scary part.
As more debt that the government gets, the more they're going to adjust those numbers to where they can get more tax dollars, because it's real easy to change those numbers. Yep.
Yeah, there's another problem. Once you hit that $10 million mark, again, here's another issue. They're calling them additional RMDs. What are RMDs, Josh?
Required minimum distributions.
Exactly, required minimum distributions. So what they're saying now is if you have done a good job, done what you're supposed to do, and saved your money for retirement, if your total retirement assets equal over $10 million, and that's total, like 401ks, IRAs, Roth IRAs, 403bs, 457s, TSPs, if you're a government worker, right? It says like all of those combined, if those equal more than $10 million, the government now says that you have enough money. You have enough retirement assets, and each year you're going to have to withdraw 50% of the excess. So 50% of whatever amount is over 10 million. So once again, if you have 11 million, now you have to take out $500,000 and get taxed on it. Yep. Yeah.
I was listening to another advisor that we listen to pretty close. He does a lot of stuff on taxes as well. And he says there's a $20 million limit as well. And if you are over $20 million, you have to take out 100% of the extra over 20 million. So if you got $23 million, you got to take out $3 million, plus you've got that 10 to 20 million. You got to take out 5 million from that. So you got to take out $8 million.
And guess where that goes? It goes in those after-tax accounts that have capital gains assessed to them, to where now they're going to be taxed on that every single year. I mean, that's the snowball, guys. That's the snowball. You know, it's like once Congress gets their hand in the cookie jar, they just want more cookies. I don't know how that I just came up with that.
I do, right?
They want more cookies. They never stop eating cookies, or they don't cut back on anything else that they're eating. That's why they're all fat and dumb. Right? I don't know. All right, that was but that's just it. That's the problem. They have all of this extra taxation that's coming in, but when are they going to start talking about cutting the budget? Right? There's not really anything in this proposal that talks about debt service. It's just all about paying for all the extra spending that they're going to be doing. That's it, right? And so here's what's crazy, guys. And I don't know if we'll set this up as a chart or not. Maybe we'll have just a little, see if we can make a little chart of this. It's easily Googleable. Actually, I'll just include the link to the article that has this link or that has this chart in it. And you can see it. It's on moneymastery.com, but it's like, you know what? Politicians talk in trillions of dollars, and that's really hard to relate to. I mean, Josh, when was the last time you saw $1 trillion?
It's been a couple days.
Yeah, we don't. We don't see trillions. And so it's really hard to equate that to something that's relative. You know, anytime that we try to make examples, we try to use examples to where it makes it real for someone, where they can understand and they can relate to it, right? And so if we took the federal budget, tax revenue, all of that, and let's say we looked at it like a household budget. You know, some of you maybe have seen this done before, but let's just knock about 8 zeros off of everything that the government is doing. So the U.S. tax revenue, and this was according to the year that this was done on moneymastery.com, the tax revenue at that point was about $2.17 trillion. So they brought in just over $2 trillion. Guess what they spent? Guess what their federal budget was? 3.8. So they brought in 2.17. Their budget, or what they were spending, they spent 3.8 million. And so their new debt created that year was $1.65 trillion. They created an extra $1 trillion of debt in 1 year. Congratulations. Great job. And so at that point, the national debt was about 14 trillion. So this has been a few years ago. It's up above 20 trillion now. And so $14.2 trillion was the national debt at that time. And the budget cuts as of April of that year, $38.5 billion, not trillion, billion. So now let's knock all 8 zeros off of there and look at this as if it were a family budget. So Josh, $2.17 trillion. How much is that in annual income if we knock 8 zeros off?
21,000.
Yep. So we got $21,700, you know, not really that high of an income, but, you know, we just knocked zeros off. 21,700. What'd they spend?
They spent 3.8?
3.82 trillion. Yeah.
3.8? Yeah. So that's 38,000.
Yep. So their income was 21,000. They spent 38,000. All right. Right. So the new debt on their credit card
was another 160 some thousand.
Well, the new debt was 16,000. 16,500 was the new debt on the credit card. So their income is 21,000, and they put new debt of almost 16 or a little over $16,000. So their new debt was almost what their income was.
Yeah, that's about a little over 3/4.
Yeah,
or pretty close.
Yep. And guess what their outstanding balance on their credit card already was before that new debt was put on there?
That was 140 some thousand, wasn't it?
Oh, yeah, because it was 14.27. So it's 142,710. So let's do that. Annual income, 21,700. They spent 38,200. They put $16,500 new debt on the credit card, and they already had 142,710. How are they going to pay that off? And at this point, remember, they did have budget cuts of 38.5 billion, right? So guess what that equals in the family income or the family budget?
$38.
385.
Oh, darn.
Yeah. So they cut $385 for the whole year. That was their budget cuts relative to everything else, guys. So remember, this is all relative. So that's the hardest part when we're thinking in the terms of trillions is, oh, all right, well, we spent 3.8 trillion. We cut 38.5 billion because billion is such a huge number that we're like, okay, well, we did have some budget cuts in there, but no, relative to everything else, really, how is it? $385 of budget cuts when you're spending over, 16,000, almost exact. You're spending almost what you made for that year, and you cut $385 for the whole year. Congratulations, you shut off Netflix, whatever.
Yeah, I was gonna say Hulu, but yeah, whatever.
Yeah, that's about it. I don't know. So there's so many dang streaming services now. You got Netflix, you got Disney Plus, you got HBO Max, you got Sling, you got Hulu, Tubi, football. I don't know. There's
yeah. Anyway,
so that's basically it when it comes to all of what they're trying to do. So guys, getting rid of the ability to, and also they're wanting to get rid of the ability to convert to a Roth IRA for anybody that hits over $400,000 of income. Yep. So they want to do away with the Roth conversion. And I've seen in some places, they actually wanted to do away with the Roth conversion completely by 2031. Completely. So that's it. Boom, gone. No more Roth conversions. They're also doing away with the big backdoor. They call it the mega backdoor Roth, actually, is what they're calling it. So you did have the ability. So once you hit a certain income level, you actually cannot contribute to a Roth IRA anymore. However, you could contribute to a non-deductible IRA and then convert to a Roth IRA because there's no income limits currently. There are no income limits on converting to a Roth IRA. You can convert at any income level right now. And so that's one of the ways that people would be able to get money into tax-free spots is they would do a non-deductible IRA contribution and then just convert to a Roth. Boom, there we go. Now we have a Roth. And so they're wanting to one, close that loophole for anybody over $400,000, but then close the Roth conversion completely by 2031, guys. And so then where are the tax-free spots that we're going to go after that? Well, there has been some tax-free spots to go even before, in addition to the Roth. And we do a lot of this in our own business here. If you properly structure life insurance, you can actually make it to be a tax-free place that you can pull money out of in retirement to help pay some of those bills or take some of those vacations and stuff that you want. It's like one of those things is like, we're not supposed to be able to call it, income, but it's tax-free money that you can use to pay your bills. Yeah. So, being able to properly structure that, I've got one for myself that I use that I'm contributing to be able to have tax-free amount of money that I can pull from once I decide to maybe ever, retire down the road. And so that's working out really well for us. The tax code favors a lot of innovative ways of doing things. And so what this is doing is a way, a lot of people used to call this the rich man's Roth IRA, because once again, this was a place that people could go if they phased out of the Roth IRA contributions. You could contribute to a specifically designed, properly designed life insurance policy, accumulate cash value on a tax deferred basis. And if you take it out the right way, it can be tax-free when you take it out. And so that still, we haven't seen any legislation that's addressed that at this point. So that would be a spot that we could still go. And that actually helps with the whole legislative risk. And so, Josh, if you want to explain what legislative risk is here real quick.
Legislative risk is whenever Congress takes, let's just use what we've been talking about now, is your retirement accounts. They can take some law, put it into effect, and it changes everything for what you had planned. That is legislative risk. They're changing your plans because they legislate it into law.
Yeah, it's everything we've been talking about. Today.
One thing about life insurance, though, so far anyway, it's like whenever they do create changes, the contracts that are already in force, they are grandfathered in with the old rules. So it's not a retroactive; it's just proactive. So it's everything forward. So if you got something in place already, it's the same as it was before, and then not to the new rules.
Okay. And I've got a few episodes where we do talk about properly structuring life insurance as well. So we'll have to link to a few of those episodes in the show notes as well. No, so check those out.
It's another reason why diversification among your asset types with the market and annuities and life insurance, all this kind of stuff is very important when you're planning for your retirement, because the less ability the IRS and the government has to change your plans, the better off you will be.
Mm-hmm.
Could be, I should say.
Yeah, absolutely. Absolutely. I think that's it. So guys, there's a lot going on in this bill that is probably still not done. It's not probably in its finished product yet. And who knows what it might end up looking like once they're finally finished with it. Whatever they will do, though, we're always in the background trying to figure out how to take care of our clients, how, if a legislative risk does end up coming into play that does change someone's plans, well, let's be flexible. Let's figure out what we can do to take care of that. And that's what we're always doing, because as the old saying goes, there are more than one way to skin a cat, right? And so that's the same thing here. If they take away something, well, we'll just use something else that does still work. That's kind of how it works. As one of my interview guests said, there's about 77,000 pages in the tax code, and only 30 of them talk about what is tax. The rest of them talk about how to lower your tax.
Yeah.
So there's always some way, and we're always going to keep our eyes peeled, our ears to the ground. That's got to look really, that's going to be uncomfortable. How do you do it? Yeah. Anyway, keep our nose to the grindstone, ears to the ground, eyes peeled. It's just all those weird sayings, right? So
that's what a good advisor does, is all these tax changes or legislative changes. Like, we have to stay up on all these to where, you may be off enjoying your retirement or getting to retirement. And it's our job to make sure that if something needs to be changes, we know about it and we know how to fix it for you.
Yeah, we want to stay one step ahead of the government, and they're definitely keeping us on our toes this year.
Yeah, that's for sure.
So, all right. So if anybody does have any questions, you're thinking some of the stuff that we talked about here, that may affect you, or maybe it's not right now, but you can see that with a little bit of growth, how this could affect you down the road. And you want to think about making some changes that could put you in a potentially better situation even before any of this stuff happens. Get a hold of us, 15-minute phone call, or once again, our calendar link is going to be in the show notes, or if you're watching this on YouTube, it's probably in the description somewhere, right? Make sure to, punch that. Let's not punch the notification bell, punch the subscribe button. There you go. Punch the subscribe button. Maybe roundhouse kick the notification bell, something like that. That way you can always get notified, because we're always going to continue to watch stuff like this and bring you guys content so that we can empower you to live the retirement you deserve. So, all right. I think that's it. Josh, any closing remarks?
No, keep abreast of all the stuff that's going on out there. If you got any questions, you can always give us a call.
All right. Guys, take care. Have a great week.
See you later.